of Girik Capital.
Well, how should you position yourself in the last hour of trade? Rahul Mohindar of VeraTechIndia.com is joining us with some closing strategies. Rahul, good to have you with us here. Thank you very much. I mean, the price action, it doesn't feel right. It doesn't look right? I mean, a bit of a breakdown on our hands, would you say?
Prashant, very well put. And, like you observed that December 26 low, that, of course, is some kind of a psychological level for many people. People are eyeing that as a support. But I think the whole makeup of the market shifted right around those points. When you see that little up move, what I termed as a relief rally, when I talked about that move last week on the show, I clearly saw that the up move was lacking volume. And, that's where my confidence went away of expecting newer highs. And I felt the market's either going to be sideways or down. And, I would still say that, quite honestly, we are headed towards 17,620 odd levels as a first target. And I think subsequently, keeping a slightly bigger perspective open, who knows, we may even touch closer to those 17,300 mark, which is near that 200-day moving average. And again, to put things in even better perspective, September's drop, if we look back, was about 7.5%. And even if we move down that much, to about 17,500, or we just about hit 7.5%. So this is really not a massive correction, within the bigger scheme of things. I think the market was probably already feeling the up move was quite solid. And I think this is really a profit-taking correction. And yes, the next 200-300 points do look slightly negative, and one has to play the market out. But from an indices point of view, my fear lies with the Nifty Bank, not so much with the Nifty 50. I think 41,200 is where we're heading on that Nifty Bank. And, let's kind of pull that through to my stock ideas, resonating with that opinion. I've got two sells on the banking names. One is Kotak Bank and one is SBI. And this is not just a short-term call. This could extend into a few days. Keep a 1820 stop loss on Kotak Bank. I think we're headed first to about 1755, breaking which we could go all the way down to about 1670. So Kotak Bank clearly looks negative to me. SBI with a 605 stop loss can be sold. We should retest about 585, 587 levels. On the buy side of things, the usual defensive play comes into mind. And ITC, as you can see, is one of those green stocks. We could probably move to about 344 on the stock. So I'd buy it with a stop loss closer to, the 330 level.
Okay, so the Nifty Bank, you see it breaking down further, 41,200. And on the Nifty, a possible retest of the 200-day moving average, which is 17,250, is also likely. But this week, we've seen very big cuts coming in on the IT index. The Nifty IT index is down 2% today for the week as well. It's lower by 2.5%. The Q3 earnings season will kickstart next week. It starts with TCS on Monday, but that comes out post-market hours. So let's quickly, in a nutshell, tell our viewers what we should be watching out. These are the CNBC-TV18 expectations. As you would see on the left column, Q3 FY23 dollar revenue growth estimates range from 0.5% going up to 3.5%. The highest is seen for HCL Tech, and that's on account of its products contribution. But if I compare it to same time last year, right, December to December quarter, you would see the growth rates were much higher back then. So basically, growth rates are likely to slow down. Now, the street is focused on the next few years and the kind of growth rates. Now, in that context, this quarter's earnings are unlikely to give you any strong quantitative signal. That will only come when names like Infosys and HCL Tech give you the annual guidance in April. So this quarter, we're not going to get color on what next year's numbers are going to look like. Therefore, watch for qualitative things like tech budgets. Are the tech budgets flat? Are the tech budgets declining? That's going to be crucial to watch. Apart from that, you watch for the deal wins. Are the deal wins further moderating? Hiring numbers are also seen as a proxy for future demand. Watch for pricing. Watch for margins. Margins are likely to expand on a quarter-on-quarter basis for the second consecutive quarter. But if growth rates itself are going to be limited from here on or not very high, can the companies continue to expand margins? What do they have to say about margins? And remember, IT companies' margins are off 200 to 600 basis points compared to their post-COVID high levels. Now, earnings estimates have already been downgraded. Now, 6 months ago, the street was anticipating that tier 1 IT companies will see a growth of at least 10% in FY24. Now everyone's talking about 7 to 8%. Is there a risk to that? And even now, FY25 and estimates for the tier 1 companies is closer to 10%. Is there a risk to these earnings estimates? As I said, it's already come down. It was 10% growth estimate at the 6 months back for next year. We're down to 7-8%, but the street fears there is more to come. And if there is more to come, the worry is the valuation derating will continue, because although valuations have corrected, they're still at a premium to historical levels. And that chart which JP Morgan has put out will come up for you on your screen, where you would see the current valuations are still about 20 to 30% higher than the pre-COVID 3-year average. And that is the fear which is playing out in the market's mind. Dipan Mehta of Elixir Equities is now with us on the show. Dipan, what would be the key triggers that you would watch for which will help you make a decision